Hey everyone, got a really exciting show for you today. We are going to tackle a topic that is blowing up on YouTube University, and that is all of these real estate entertainers talking about huge opportunities, foreclosure waves, short sales, and now we have people calling for a 50% price drop in 2021 for single-family homes for the nation. And I think that's crazy. I think that's lunacy. But you know what? I'm going to bring in some of my experts and we're going to talk about it. So Mondays, we talk to Greg Dickerson. How you doing, sir?
I'm doing great. Michael, how are you?
I'm doing really, really well. So we're going to peel this apart in chunks, but I'm going to ask you for a percentage from between 0 and 100%. That's the first question. And then we're going to dive in on the likelihood that single family homes in the great country of the United States falls 50% in 2021. What do you think? Somewhere between 0 and 100.
The likelihood of that happening, 0.
Yes, I got it right. It's not, I mean, when you start putting together all the pieces that have to fall into place and the timelines, I mean, you would just have to have a monster list of foreclosures by March just to make the timeline work. And that's just not going to happen. Let's talk, because again, there's so many things that just make this a stupid claim. First, let's talk about the lending environment, how it's different, because most people remember the last Great Recession, which, oh, by the way, was 3 years in the making, not 12 months, right? The crash, right? So first off, that was longer, folks. But the lending structures were very different between, call it 06, 07 and 2019 and 20. Want to talk about that first?
Yeah, so the biggest difference, and we've talked about it here before, and, you know, I saw Ken's thing and some of the reasons he cited for what he's saying, and he's way off base. Now, Ken's brilliant, smart guy, but, you know, he's a rich dad guy. Robert Kiyosaki is a bit of a conspiracy theorist. He's a bit out there. Okay, so Kiyosaki is way off the map, guys.
There.
Yeah, and he's talking about just all kinds of weird stuff, you know, and Ken is kind of gets on that train a little bit too. But yeah, you know, back then you had the subprime mortgage crisis. So what was going on was they were pushing home ownership. They were giving loans to unqualified buyers. Now, that was low income buyers that could not afford mortgages. And it was also real estate speculators like you and me. I was getting loans that I should not have been able to qualify for houses. I had multiple second homes because, you know, if they were so far apart, you know, by 5 miles or whatever it is, it's like a radius thing. Yeah. I mean, literally in my area with these multi-million-dollar beach houses, I had, you know, second homes 2 or 3 miles apart from each other, you know, with different banks. So that's not loan fraud. We went by, you know, the rules of the mortgage industry, and it had to have a certain radius. And I was in a linear environment, so I could have multiple second homes, which people do now. And then the rest were investment homes. And, you know, Bank of America was loaning me as many of these things as I wanted to do. And banks were loaning as many as you wanted to do, as long as you had a good credit score, as long as you had equity. Now, here's the kicker. We were getting loan to value, not loan to cost, whichever's higher.
Absolutely.
You know what I mean?
Yeah.
So, you know, not whichever's lower. So that's the other thing. So they were lending 80 to 90%.
Every loan I got after the first one was 90%. Everyone.
Value, appraised value. So
value.
It wasn't what you were paying. It was the appraised value.
Correct.
You know, which was always either what you were paying or more. And so very, very different environment, very little qualification, if any at all, you know, for the borrowers. So fast forward to now. Now, also the rates were very different too. We are interest only.
Let's talk about that, because not only rates, and maybe this was just investors, maybe this was a West Coast thing, because everything you've said is dead on right and exactly why one of the reasons Ken's wrong. But there's one subtlety I think you missed, and maybe it wasn't on the East Coast, but a lot of the investment loans, they were adjustable rate mortgages. So they had, you know, 2, 3, 5 year periods where you had to refi. And the story for investors were, don't worry, prices only go up, you'll refi later. Right?
Yeah, and that's where I was going next with interest rates. So interest rates were low because everything was based on LIBOR, London index rank. So we switched. That wasn't the thing, and that wasn't a thing before 2007-8. We switched to LIBOR with a lot of these investment loans. Interest rates dropped, you know, even more. So it was interest only. And it's like you said, some were 1 year, 3 year, 5 year. And so, you know, there were a lot of people that were locked into these products that had to refi. And then what happened was interest rates started going up. And I looked at it this morning because I saw your video, I saw Ken's, and I was tracking all this data. Okay.
Right.
So I was looking at a lot of things that we'll get into, but one of them was interest rates.
Yeah.
What were the interest rates back then? And they were 5%.
Yeah.
And I remember they started climbing, after that. Now, that was 5% for conforming loans. So you got to remember, subprime is not conforming.
Yeah.
Loan to values were not conforming. So
Yeah.
the rates were actually more around 6 or 7%.
Yeah.
And there was zero incentive or appetite for the lenders to work these loans out with borrowers. They were just taking them back because the banks were just being silly.
Yeah. Well, let's get to that in a minute. Let's get to that in a minute. First off, folks, the foundation of the loans in, let's just call it 07 versus 2020. Fundamentally different. The foundation of the loans that were done were bad. They were non-qualified liar loans. They were at least a lot more adjustable rate mortgages. They were on value instead of cost, and they forced people to refi in an environment that was falling, which just then the strategic default came. So the first thing for me is the foundation of the lending environment, vastly different. Much higher quality today, much lower rates today, much more fixed rate 30-year debt. I have not heard anybody take an adjustable rate mortgage in today's environment. I'm sure it happens. But
Well, it's out there, especially in commercial. And, real estate syndications. Real estate syndications is where you're seeing a ton of those. Now, they're value add and and they have a short term. But the other thing, too, was inventory levels are very different back then than they are now. There was inventory back then. There's no inventory now. So you couldn't sell a house back then because everybody's house was for sale. And, there was only so many houses, selling every year. Whereas now, what is it? 4 or 5 million houses a year sell right now. Back then it was just this huge flood and, values were dipping. People were bailing on the loans. And again, it was a very different environment, where the borrowers were not qualified. Nowadays, you got to put the right amount of money down. You have to be qualified. Your debt to income ratio has to be, correct.
Reasonable.
Yeah. Reasonable. And there's zero inventory. So, right now, I think in the forbearance, there's only 3.5 million houses in the country that are in the forbearance program. And again, that's just a breather. That's all that is. And I know the argument is, well, at the end of the forbearance, they have to make up all those back payments. Well, that's what it says, but that's not the rule. And that's not what's going to happen. What's going to happen is once you get there, if the borrower can't pay that, then they're just going to take that chunk, add it to the back of the loan and re-amortize. So it's going to turn into, it won't be forgiven. It's not going to go away. It's just going to be, added to the back of the loan, and it's just going to extend their loan, and increase the principal balance, almost like a negative amortization. So that's all that's going to happen.
So the foundation today, not quite granite, but certainly stronger than the termite infested log we had in 06. Totally different game. Totally different game. Now, the same thing, totally different last time versus this time, is banks. And that's where you were going before I interrupted you, right? Last time, banks told people, we will not work with you until you were seriously delinquent, which meant 90 days, right? So that just became the thing. Oh, cool. No mortgage payments for 90 days. Awesome. Then the banks would work for them, go to the short sale, foreclosure. Today, the banks are proactive by legislation and by just care for their own balance sheet. Right? Oh, you need 90 days? Check this box on this website, right? You don't even have to prove anything. And they'll just extend it. Right now in the CARES Act, they can get up to a year. It's 90 days at a time. But think about that, right? Banks are fundamentally different today. Banks, to your point, when you get to that conversation, which will be difficult and blah, 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 but you're going to say, I can't do it. I just got a job. I can start making my regular payment, but I can't make up 10 months. I can't pay the late fees. So the banks are going to go, okay, well, we'll stick it on either the back and just reamortize, or something in the CARES Act says, I think, or they added to it, says they're going to just create a second, make it 0%, not make it due and payable until the first is paid off, which basically means if you ever refi or sell it, it gets cleared, right? So
which is a set aside.
The banks are just wildly different today. Now, yes, some people will be foreclosed on and some banks won't work with people. And yes, but the vast majority of people will be helped. Last time, nobody was helped. The banks handled it wrong last time and they know it. So they are doing things completely different today. Would you agree?
Oh, absolutely. And, like you said, every borrower is different, every bank's different. So there's going to be a little bit, but
Yeah.
to say that housing across this country is going to drop 50%, and there's this huge wave of foreclosures, about to hit the market. Again, there's only 3 million in forbearance right now. If every one of those foreclosed and hit the market, they'd be gone in 30 days because that's our absorption rate right now.
Yeah.
And probably less than that. So they'd be sold.
Yeah.
And, again, these borrowers, most of them have equity or the ability to sell, even if they don't have equity, even if they don't, they can still usually sell enough to pay off their loan because they got their loan, a couple of years ago, so every houses have gone up, and appreciated all across the country. So pretty much anybody who's bought in the last 3 years has equity or before. Yeah. Even if you bought last year, you've got equity now, even if you bought at the top of the market last year, unless you obnoxiously overpaid for something, which, at the higher level is happening. Yeah. So that's where you're seeing a little bit of that. Now, what I will say is, like in my area, big estates, big farm properties are the thing, right? Like people came in and paid $20, $30, $50 million for these, 100-acre, 300-acre, 1,000-acre farms. Some of those have sold at 50% of what they bought, but you're talking about wealthy buyers, they just don't care. They're just like,
it was cash the first time, it was cash this time. Yeah.
And that's again, not a wave of them. It's a few here and there. And it's very different.
Yeah. And again, I think you're going to see New York and San Francisco take haircuts, but remember Ken's point, and frankly, it's not only Ken's just the most visible, is saying 50% single family homes for the US. And that is just not possible.
It's nuts. It's just this, I don't even know what he's thinking or why. He's much more credible than that. It makes zero sense for somebody like that to come out and say something like that because it just can't. Well, I don't want to say it can't. It's just not going to happen, unless.
The only thing that would make that happen, and you and I have talked about, is if for whatever reason, interest rates had to go from 3 to 6%, that would smash real estate. It would kill the market, which would kill values. And then the theory would be, okay, so if everybody's losing value in their house now in equity, do they then strategically default? But again, the reason, so here's the other reason. Why were people strategically defaulting? It wasn't just equity. It was because of their payments. It was like you said, interest rates, number one, were much higher. They were twice what they are now, almost double what they are now. Correct.
Okay, so think about that. So right now, even if your house is worth half of what it is today, it's still cheaper to own it than it is to rent with that interest rate if you've got a long-term loan, or it's about a break even.
Yeah. Probably.
So from that standpoint, you got to live somewhere. Okay. And most people's mentality, 65% of the country's mentality is I'm better off owning and paying principal. So at the end of 30 years, I own this asset versus renting where at the end of 30 years, I don't own anything. So that's people's mindsets. The whole appreciation question is out. So why people were strategically defaulting was they had this huge payment they couldn't afford. They weren't building any equity. It was interest only. It was adjustable. So they had no reason to stay in the house because they knew they weren't going to pay it off and they couldn't afford the payment. Absolutely. So that's what was going on back then and why they were strategically defaulting. It's very different now. And if all the real estate lost value, people are not going to strategically default because the interest rates are so cheap, so long term.
Not at the same numbers. There's just no chance, folks. So again, the structure or the foundation that I call it, the lending book, completely different. We have banks' behavior with the few that do have problems, totally different. Then you have, oh, by the way, the people that are in trouble, like you said, I don't know, 80% of them or more have equity. And you know what doesn't cause a short sale foreclosure? Equity. Right. Yeah. If you're in trouble,
even in San Francisco, like you've got some pain there, but there's still pockets there at the high end that are still multiple bids. People are wanting them, so you still have that going on. Now let's talk about interest rates for a second. That's the only thing that could really negatively affect the values of real estate. And people are not exponentially paying just way out of line. There is a price point threshold that people will just not buy. Sure. So people are being more reasonable, and so are the lenders. So here's the thing, folks. So what's going on is you still have to put 25% down, okay? So when that appraisal comes in, if you're exponentially paying above market value, the lender's going to require you to make that difference up between the appraised value and, what the loan is, okay? So people aren't willing to do that. They're still willing to put 25% down, but they're not going to exponentially put, another 5, 10, 20% down to make up that difference. So that's what's keeping pricing in check. And it's in check relative to the interest rates. If you did the math and went back to interest rates then and values, it's kind of the same. And it's kind of the same as it has been over the years. So interest rates are the key. So Right now, there is absolutely no way interest rates can exponentially increase because of what's going on the global economy as a whole. The Fed came out last week and said, we're not going to raise rates for any time soon, years.
Mm-hmm.
Now, what they didn't do was they didn't provide any guidance on QE. And that's why the markets are throwing a fit and doing what we're doing now. They're testing the Fed's resolve in terms of what they're willing to do from a QE standpoint. So that's what's going on with the stock markets right now with the sell-off. Profit taking plus the markets testing Powell's resolve in terms of QE, quantitative easing. Are they going to come in and bail stocks out?
Yep.
The Fed's ability to do that is not unlimited. They cannot exponentially replace market valuation that's lost in the markets, in the stock. They can't do that.
No.
They can do, and what they will do is they will prop up the banks and they will make sure that we do not have a real estate problem. Now, the question is, and where Ken can be right, is if you flip the conversation to commercial and multifamily.
Totally agree. Yeah, that's it. Yeah, I was
retail, hotel,
absolutely
those types of things. Office. There's some. I could see prices dropping 50% on those assets. It's already happening on some.
Oh, yeah, there's no question. Hotels, hospitality. Yes. That's why I'm very clear, right? He said houses, which is what you would, you're a big boy, so you can play in the bigger game, but most of us are single family home, duplexes, quads. That's why I'm very specific. No, let's bring it back to residential.
Yeah. Okay.
So the other thing that people need to realize, let's just say for whatever reason, there's this mountain of people, the economy goes crazy. We enter a depression. None of these people can get jobs. We have 40% unemployment, just nasty, nasty scenario. Even if the government allowed foreclosures, which I think they would just do another freaking forbearance period, but let's just say they gave up. There's a timeline to do this. And then you have judicial and non-judicial states. On judicial states, they're the slow ones. There are people still in the 2008 crisis that haven't paid mortgages, like Miami or Florida and New York, who are judicial states. Let's talk about California. That's where I am. Here's the timeline, folks. First, you need to be 4 months late on your payment before they can file what's called a notice of default, NOD, right? And remember, you're in a forbearance period. You're going to come out of that. You're going to be current, right? That forbearance period is not part of your delinquency. You're going to be current the day you come out. You have 4 months before they can file an NOD. After the NOD or notice of default is filed, I believe you have 60 days, it might be 90 days, before that asset can then be put and sold at the county or the courthouse or whatever they call it. And yeah, it's just a long process, right? You have, I think I counted it yesterday because I sketched it out somewhere. You have 7 months from your first payment miss until you could best or worst case lose your property. That's assuming no delays, no paperwork missing, the system's working along, which it doesn't. Oh, by the way, there's no holidays because they're going to do a foreclosure moratorium around Thanksgiving and Christmas. Nobody should lose their home in Christmas, and it just can't happen. I mean, just the timeline alone is 7 or 8 months long. It doesn't make sense.
Yeah, it's just not possible. Now, could there be one house in one neighborhood or a few? Sure, but not nationwide, not averages, not housing, not nationwide, and it makes zero sense, and there's absolutely no data to back it up. And I don't think he used any data. All he said was, people have lost their jobs and are losing their jobs. And again, most of the people that have lost their jobs are renters. It's in the hospitality sector. It's in the service industry, and what we've seen is at the worst part of the pandemic with the most people out of work, we know what the economy looks like there. Yeah. And so here's the thing too, talk about depression. Okay. They're saying, oh, there's this depression coming. Kiyosaki's saying there's this depression coming. Okay. Depression is defined as 10% decline in GDP for 3 years or more. That's a depression. Yeah. If you look at the official definition, recession is simply a decline in GDP. We're in a recession. We've been in one. We were at depression levels in March when the GDP declined probably 30%, for that month. Yeah. But overall, the projections, and we're on pace to end about 19 trillion this year versus 21 trillion. That's only down a couple of points. That's a couple of points.
Yeah, single digits, yeah.
Right, that's nowhere near depression level, okay? Right. So what you'd have to have is 30 to 40% of the population unemployed for a sustained period of time, effectively unemployed. The real numbers will probably show more like, 20% maybe or 15. Yeah, somewhere there. Sure. And we talked about that last time. Where we are at right now, our effective levels of unemployment are much higher than what's being reported. In the teens for sure. Yeah. Yeah. So you'd have to have that. And that we've seen that even with the economy shut down, 70 to 80% of the economy is still functioning.
Agreed. Yeah.
The service industry.
Yeah.
Retail, service, that kind of thing. The rest of the economy is still functioning. So we can't really even get to a depression level given the current environment of what's going on.
Yeah. I mean, there are so many things that have to go wrong between now and, I don't know, February, March to bring depression back on the table. I don't see it coming. Again, I'm still very confident on two things. One is we are going to have more pain in 2020. This year is kicking everybody in the teeth. I think the stock market has more pain. There's more pain, but I'm still, as we've talked about many times, 2021 is going to be a year of the comeback. I think it's going to be a bang-up year.
The stock market is just overinflated free money. That's all that is. It's a bubble, and I've always said you're going to see Dow 15 before you see Dow 30.
Ooh, there you go.
There is no, I've said it all along, and going back to, when we were first starting this in March, we're going to see, you want to see a 50% nationwide cut, it's going to be in the stock market. Because 50% of where we just were is where we were in March when this whole thing started, which is arguably.
As of right now, just so you know, I don't know if you're watching, it's down 900 points. Yeah. 910 points. Yeah.
Which.
Dow 15, huh? Oh, there. That's the only, again, everybody asks me, because I'm such not a stock guy. Everybody asks, here's the deal. If the stock market ever hits Dow 15,000, I will buy some stocks. I promise you.
But, and that's where I was at back in March when it was at, what was it? What was the low in March?
21, I think.
No, 21? It was in 18, 17,
oh, was it?
18,
okay.
something like that.
Yeah. 50%. That's the only time I play.
And it didn't go far enough. It wasn't done, Yeah,
it wasn't done.
So everything we've seen, it's just speculation, and it's just, retail investors goofing off and the Fed pumping money in. So, we're going to pare back down, and we're going to revisit all that because the valuations aren't there.
I totally agree.
It just doesn't, I don't care what anybody says. There is no there's no support for the market where it's at. It just doesn't work.
Well, here's the deal. The other thing we just need to realize is we are, given the passing of Supreme Court Justice, I believe that is now the number one priority for Congress to fight. I'm not going to, it's just going to become the topic of the day, whether or not they nominate or approve or don't. But that has ramifications for the country. First off, I was generally positive last week, and I think I did a video on it Wednesday saying, you know what? For the first time, I think we get a stimulus deal. It's probably about 1.5 trillion. We probably do everything except bail out the states. Hey ho, let's go. That'll get us through the end of the year. It won't be great, but we'll finish the bridge that we built with CARES Act, right? Because right now we're just falling off a cliff. Now, with the passing of Ruth Bader Ginsburg, I believe the stimulus is off the table. I don't think another stimulus bill gets done.
I mean, we're getting too close to the election right now, and there's too much to argue and fight over. But here's the thing. So regardless of who wins, regardless of how the election goes, we're not going to see a whole lot of difference in anything because we're still in the middle of the pandemic. So the economy, you're not going to see fundamental shifts either way, regardless of who's in office, I don't think a Biden-Harris thing is going to be all that bad. I don't think a Trump thing, different from an economic standpoint, what I'm saying? And I'm not, I'm a conservative. Okay. So I'm not going one way or the other. I'm just saying the end of the world is neither nor, know?
I agree.
And we are still in a huge issue with this coronavirus. And until we get that taken care of, nothing else matters. We can't go back to full capacity until you have a vaccine and you've got therapeutics where ventilator and death are off the table. Those need to be eliminated from the conversation. And those two are more important than the vaccine. So until we get there, we're not 100% open. Again, I went to the movies again this weekend, and we saw Infidel, and the other one you were asking about was Words on Bathroom Walls. We saw that.
Okay.
Yeah, that was a really good movie. And then,
I'll take a look.
Yeah, so we've seen a couple, 2 or 3 of them. We saw David Copperfield. That was a good one. You were asking about movies. So anyways, again, there was 4 of us in the theater this weekend, my wife and I and 2 other random people. So people are still not getting out. They're still not flying. They're still not going to hotels. They're still not, the conference business, the event business. There's still a huge part of the economy that's missing that cannot come back until we get control of this thing. There's a huge resurgence in Europe right now.
Oh, yeah. Spain, UK,
The only thing that could take us worse than where we are now, which we've kind of leveled off, is if we get back to a point to where we're on a more of a lockdown and restaurants get shut back down again, and you can't, because it's interesting. People aren't going to the theaters, but they're packing into restaurants.
They are.
There's much more space in theaters, folks. Go check it out. Restaurants, man, you got people right next to you,
Yeah, crazy.
So anyways, until we get rid of that, we can't come back fully as an economy. But I think we are in the worst of what we're going to see economically from the coronavirus. And I just don't see a major shutdown to where nobody's open at all and doesn't know what to do, because all of the restaurants have punted. They know how to operate now. All of the retail environment has punted. They, whoever knows is going to stay open and operate, they've figured it out. So we figured out how to operate in this environment at the level we're operating. So I think from that standpoint, unless it just gets way out of control and, everybody starts getting sick and dying, at a major, major scale, I don't see any downside economically from here. From a GDP, consumption standpoint.
I don't know. I'm going to slightly disagree. I do agree with you about you got to take death off the table, and treatments and ventilators that's where we have to get. That's when people have confidence again and we can go back screaming higher. But I really do think the miss of the additional stimulus for the bottom rung, right? The people who are working in hotels and restaurants.
Well, that could be a big factor. Yeah.
That is going to be a problem because unlike you and I, we save money. Right. We, they
and earn.
Oh yeah. But we're earning and saving. They're earning and living. And that is part of GDP that we will miss. And
well, the $600 bonus. So that was a big pump that kind of propped things up and kept things going a little bit. Now it's down to $300 for most states, but very few people have been able to take advantage of that. So there is that component. Yes. And that segment of the industry that's off the table now that was there before. So the question is, what's the real impact of that portion of the economy having that spending, limited, capped, eliminated? So, and we're going into the holidays, which people are spending more and things like that. So I think, the rest of this year, what I'm saying is I think where we're at right now, economically, the rest of this year, we're probably okay because there is still a little bit of support there.
Sure.
But going into next year, you're right. So if there is no support above and beyond state level unemployment that people can get that are out of work, what does that look like and how does that affect the economy? That's not a huge factor. That's not a big, huge dent.
Yeah, they spend a lot of that money though. They spend over 90% of that stuff that comes in, at least by research I've done. It just makes me nervous because that could be a series of dominoes, right? You take whatever percent, 15% of the population, you remove the ability to do anything extra other than feed themselves, right? Because they were paying their rent or their mortgage if they were lucky enough to have a home with that 600. Right now that that's gone, right? We're going to start seeing, we've seen the lowest rent collection of the year as of this September. As of the 13th, it was like, and this is not my number. This is a national number, 86%. I think it gets worse from here.
Yeah, because we're getting into the holidays, so people need to spend on those things. So rent's going to take a back seat because there's no evictions through the rest of the year, that type of thing. So yeah, you could potentially see in the rental market where that will play out, but that still keeps money in the economy.
True.
So if they're not paying rent, they're spending it elsewhere.
That's a good point. Yeah.
You know what I'm saying? So, and again,
right.
I said significant dips,
Right.
in economic levels that we're seeing right now. So I think for the rest of this year, we're fine. Next year, I don't know. And again, a lot of it depends on what happens with, the coronavirus and what does that look like, in terms of, shutdowns, economic activity, things like that. So, October, November, December, we got 3 months left in this year.
Yeah.
I think we're okay there, but going into next year, that can be a factor, but depending on whoever's in office, that's when you start to see things happen, with stimulus and support and, things like that. And I don't think unemployment are going to get completely left out of the equation because they were given that $300 bonus.
Sure.
So it's not 6, but it's 3, which arguably makes more sense.
For sure.
In terms of what probably the real value of what needs to be replaced.
Yeah. Yeah, man, this is interesting. And again, I think these YouTubers, including Ken, they want to, I don't know about Ken. I'm going to say the other ones. They're putting it out there because they know scaring people gets clicks.
It could be. Now, his argument was based on the assumption that unemployment was what's going to drive mortgage foreclosures and defaults, right?
Mm-hmm. Yeah, basically.
Defaults and foreclosures. He's saying unemployment.
Yeah.
Okay. Well, we're not there now.
Yeah, exactly.
What's going to take it there then? Now I know there's more closing, store closings and all that, but that's kind of attrition. That's kind of working itself out through the economy because there was too many of everything to begin with and not enough employees to go around.
Yeah.
So whenever one store closes, those employees just go to the other.
Yeah.
So they're there has been plenty of jobs. Because remember, our unemployment rate was very, very low.
You know,
almost, almost too low, right? A healthy unemployment rate is probably more around 5.
Yeah, I agree.
In terms of the competitive environment, you know.
The other thing I forgot to say and why, again, I'm not saying that housing can't fall 50%. Yeah, it could. I'm saying it can't fall 50% in 2021. And the other thing you got to realize, I invested through the entire last crisis in real estate in my market. Like I have a house I sold at 264 that eventually retraded at 75, more than 50%. But that was 4 years in the making, right? The worst month-on-month drop in my market, which was crushed in the financial crisis, was 2%. Even if you take 2% and compound it month after month, you can't get to 50%. It's not mathematically possible. Real estate, single-family homes is not the stock market, people. You can't wake up and be Nikola or Wirecard or whatever and be a total fraud and go to zero. It doesn't work that way. And for Ken to say it'll fall 50% in a year is just flat out wrong. It just
well, the only way it could really happen would be interest rates would have to just double. Okay, they would just have to double, and that's going to stop buyers. Okay, so if interest rates double, people stop buying, inventory stacks up, prices come down.
Yeah, then even that doesn't get 50%. All right, let's just say it happened January 1st. Interest rates go from 3% to 10. Buyers disappear. Sellers wait 30, 60 days because, you know, prices are sticky on the way down. Then they start making cuts. It doesn't get to 50%. I just get time.
Not by the end of next year.
It just does. I mean, that's the rub, right? Do you want to call 50%? You want to call this a bubble? You want to say, we'll see if it, fine. But once you say 50% nationally in 2021, there's just zero chance.
Yeah. And that's why there's no statistical information or data to back that up. When we're talking about numbers, okay, right now there's about 3 million people in forbearance. Okay. Yes. None of the almost, let's say half of them at best, half of them might end up in foreclosure at some point. That's only 1.5 million. We're selling 5 million homes a year right now.
Yeah. And that 1.5 million, the difference between last time is they will come on onesie twosies. Right? It won't be this wave. I remember last time, every Monday morning, a big freaking wave would hit my.
Let's talk about stats again. So back then, it started out 900,000 foreclosures, you know, in 2009 when it started. And then it was, you know, almost 3 million, 2010, almost 3 million, 2011, down in the twos, 2012. So these are real numbers. So that's how many houses were getting foreclosed on per year during that time period, you know, and I didn't look at this year what the foreclosures were this year. Yeah. But, you know, it's probably, I doubt it's even 500,000. I don't even know.
Probably not even
what
that.
It would be.
Yeah.
I'd have to look at that because that's a real number.
Yeah. But in the end, folks, there is 0% chance we have a 50% crash in real estate in 2021. Just no chance. Oh, he's looking.
So I'm looking it up right now. 37,917 properties in the first 6 months of 2020 were foreclosed on.
Yeah, it's just not.
That's the lowest rate since 2005. You know.
Yeah, folks. So again, it's just not going to happen.
We didn't even drop 50% in 2008 and 9 when you had 3 million.
Exactly.
You know, values. It took 5 years. So here you go, Ken. It took from 2008-9 until basically what was the bottom of values around 2011.
Yeah,
it took 3 or 4 years for some markets to see a 50% decline. And that was only very few markets. And it was
the worst markets. Exactly. The worst of the worst. And the nation never fell 50%. Never did.
No, nationwide values only dropped 20-25%, I think, in housing during that time period.
The worst of the recession where single family homes were the asset of choice that had all the problems, a 20% drop. And it didn't do it in a year. It did peak to trough.
So this is the real no spin zone based on data, based on facts, based on, you know, real time information. And this is all trackable that you can look at, you know, through all the websites, you know, government websites that track this data. So you can find these numbers out there. It just is what it is. So it's just not possible unless you just have to shut the entire economy down for that to happen.
Yeah. All right, buddy. I appreciate you.
So what we do know, the Fed said, hey, rates are low forever.
Yeah, exactly.
We do know they cannot change that. They can't raise rates. They're stuck.
The
only thing the Fed has left to do, the only thing they have to do to battle this economy is to just pump money out there. So where are they going to pump it? Propping up mortgages, propping up commercial real estate, propping up the stock market.
You got it. There you go. All right, man. Well, I appreciate you. This is a fun conversation. I'm I'm encouraged that we were on the same side of this one because I didn't know.
Yeah.
Thanks, buddy.
Awesome.